Good morning, guys. Welcome to Mug Briefing. General Motors is preparing to build more cars in South Korea next year, and the reason is simple. The company believes it can sell them overseas. In simple words, GM's Korean unit says it plans to run its factories harder in 2026 to ship more vehicles to export markets, especially the United States. That matters because it ties American car availability, global trade policy, and factory jobs in Asia into one decision. Here's what actually happened. According to reporting from Korean business outlets in early February 2026, GM Korea told reporters it is targeting production of about 500,000 vehicles in 2026. That would be up from roughly 460,826 vehicles in 2025, an increase of about 8.5%. The company described this as a production target, not a legally binding commitment. The plan is to run its two main plants, the Bupyeong factory and the Changwon factory, at higher capacity to meet overseas demand. Coverage quotes company representatives saying parent company General Motors has asked the Korean operation to maximize output to support export channels. The increase is tied mainly to specific export models, especially the Chevrolet Trax and Chevrolet Trailblazer, compact SUVs that are shipped from Korea to markets including the US. GM has not published a detailed month-by-month production schedule, nor has it released signed sales contracts guaranteeing demand. The company is projecting demand based on internal forecasts. That's normal in auto manufacturing. Production plans are built on expectations, not certainty. Some details are confirmed, others come from industry interpretation. The production numbers come from reported company figures. The percentage increase is math based on those totals. Investment references, roughly $300 million in prior plans, come from industry reporting rather than a fresh press release tied specifically to this announcement. Tariff risks are mostly flagged by analysts and reporters watching trade policy, not presented by GM as a warning. The company is focused publicly on capacity and demand, not geopolitics. Why now? Several forces appear to be aligning. Demand for small SUVs remains strong in export markets, and supply chains that were strained during earlier disruptions have stabilized enough to allow higher output. Exchange rates and production efficiency also matter. Building in Korea can be cost-effective for global distribution. This does not look like a sudden relocation from another country. It looks more like GM using available capacity where it sees competitive advantage. It also fits a longer pattern of GM optimizing global production footprints rather than expanding blindly. What this likely means is that GM sees Korea as an efficient export hub at this moment. Supporters would argue higher plant utilization improves margins because fixed factory costs are spread over more vehicles. Critics point out that auto demand can swing quickly, and running plants at full tilt creates risk if sales cool. Both are true in manufacturing cycles. Auto companies constantly balance efficiency against flexibility. For Americans, the most direct impact is inventory. More vehicles coming out of Korea could mean better availability of the Trax and Trailblazer in U.S. dealerships in 2026. That may shorten wait times and stabilize pricing if supply improves. It does not guarantee cheaper cars, but supply pressure is one ingredient in pricing. U.S. logistics firms and part suppliers connected to GM's global network may also see higher activity as exports rise. For Korean workers, higher utilization usually supports job stability, at least in the short term. Running plants closer to capacity tends to protect factory employment. For investors, the picture is mixed. Higher output can signal growth, but it also concentrates exposure to trade policy. If tariffs change or global demand weakens, the economics shift quickly. That's the risk side of an export-heavy strategy. What happens next depends on whether demand matches expectations. GM could revise the target if orders soften. Other global plants could see adjustments if production needs to be rebalanced. Sustained success might justify further investment in Korean capacity. On the other hand, trade disputes or tariff changes could complicate the plan. Auto manufacturing is tightly linked to policy decisions that companies don't fully control. It's important to understand what this does not mean. This is not proof of a global auto boom. GM is not abandoning production elsewhere. A higher production target does not guarantee higher profits. It is a strategic adjustment based on current forecasts. Auto companies revise plans constantly as markets shift. The story would become more serious if export numbers fail to match expectations, if new tariffs change the cost structure, or if plants run at high capacity only to face sudden overproduction. Those scenarios create pressure for layoffs or restructuring. For now, the key signals to watch are monthly export figures, GM earnings commentary about Korean operations, dealer inventory levels in the US, and any resurfacing of tariff negotiations. In essence, GM is betting that demand for its Korean-built SUVs will hold strong enough to justify running factories harder. It's a calculated move to capture sales while conditions look favorable. The decision connects American car buyers, Korean factory floors, and global trade politics in a single supply chain. Whether it proves wise will depend less on factory speed and more on how steady the market stays once those extra vehicles start rolling off the line.